Welcome to Hitting Home. I'm your host, Arif Khan, and it is my pleasure to be joining you wherever you're consuming this content, online, on cable, and thanks for having me in your home or on your device. I wanted to pick up on a theme and continue along a theme regarding real estate and real estate as an investment opportunity with you. And with that in mind, I've got a great guest joining me today, Arjun Batra from First Construction Real Estate Group. Thank you so much for joining me on Hitting Home, Arjun.
Thank you, Arif, for having me.
Absolute pleasure. I've been watching your career. I've been following what you're working on online, on social media, etc. And had to reach out to you and call you and ask you to join me on the show because I love what you're doing and I love how you have read the market and you are bringing product to market and you are educating consumers on how they can tap into this, especially in light of so many of the changes and fluxes in the economy, the demand for real estate, the demand for affordable housing, the demand for accessing affordable real estate tenancy opportunities. So thanks for coming on. Let's get right into it.
Yeah, thank you. I mean, I feel like my background in education, I've been a teacher for almost 15 years, brings that to the table where I'm able to explain the investors about the pros, cons, and what's happening, from a point of view as a student, that when the student has a question, you got to explain them in the most easy way, the 101 way, so that they understand the content. And when someone understands it, they're always, over time become more savvy and more confident in their investment strategies. So what we bring from First Construction Real Estate is an opportunity for investors who are, kind of learning, and also to the people who are pro. Like we bring the products to the table which are in the multi-family segment, basically.
Yeah, absolutely. And I'm glad you touched on that. Actually, you are a teacher. In fact, not only are you a teacher, you've actually founded a school designed to, and this may not be the show to go too far deep into that, but designed to really change the way students are consuming and processing and understanding the information. And I think it's a natural fit that you've actually done that with bringing that to the public in general through your client offerings. So I want to just give a little bit of background as well. You do have a dual MBA from Cornell, if I'm not mistaken, as well as Queen's.
That's correct, yeah.
Correct. So numbers are your thing?
That's right, yeah.
And teaching and education is your thing. Let's do some of that here in this first segment. And I think the reason why I wanted to start here, as opposed to diving into some of the what you bring to market, exactly what you talked about. Many of us go through the education system, we enter into the workplace, we find ourselves getting a good job, something that is stable, something that can put food on the table. Maybe we start a family, and genuinely our first exposure or experience with investing in general is maybe at the teller, maybe during RSP season or TFSA, tax-free savings account season, maybe a conversation with our employer if we happen to have some benefits where someone is telling us what the corporation is offering or maybe what the union is offering, something along those lines where we get to pretty much choose from high risk or low risk, preservation of capital versus a growth opportunity, and we kind of read a brochure and we select where we're going to participate. And that's kind of, and I might be simplifying it a little bit, maybe you can give me a little bit better insight or give our audience a better insight, but I'm trying to summarize our initial exposure to investing.
Yeah, I feel like a lot of the investment for a person in general is to do with a lot of unknowns. They're often not savvy to know where the money is going or where they're investing through different mediums. Real estate is one of the ways where there's more transparency to the transaction when someone is buying or selling. So the exposure is more simple. It's way more simpler than people think when they're investing in this segment of asset class, which is in multifamily or in real estate in general.
Mm-hmm. Fair enough. And my experience and the experience of my children and colleagues, et cetera, has been pretty much in line with what I described, and maybe I'm biased, and I'm going to give full disclosure, maybe I'm being completely biased in that experience. However, one thing I know for certain was I'm not the one driving the vehicle at that time. I'm the one who's subscribed to an offering, and I'm relying on someone else to manage that for me, unless I become a day trader. But typically speaking, I'm not choosing the exact companies that I'm investing in, and I can't touch it, I can't feel it. I'm typically getting a quarterly report, maybe an end of year, an annual statement that tells me how my portfolio has performed, and I pretty much either open it or don't open it and see what happens in 20 years when I get there. This is very different. And now tell me, we were talking offline, and something that came to my mind was, every single person has had some form of an experience when it comes to real estate. We've either grown up in a house that was owned by our parent or our guardian, or maybe we grew up in a home that we were tenants. But at some point along the way, we're familiar with the concept of living in a home, whether we own it or we rent it. Yeah. And you're coming to talk to Ontarians. You are operating in both Ontario, if I'm not mistaken, and in Alberta?
That's correct, yes.
And you're speaking with Canadians about investment in the real estate asset class, something that you believe people should have already an edge in terms of familiarity around.
Yeah, I agree. I feel like, in general, investments, in general versus investment in real estate is different yet similar, right? The mindset is something of savings to be made and put it on the side and forget about it in general, right? I mean, you shouldn't be tapping into that money and thinking about it to be used unless required. When we talk about investments in real estate side, I feel that there is so much scope and growth in this segment in general because of how the markets are in Canada today. There's immigration, there's a lot of migration happening. So when investors are looking for opportunities, if they have done their high-level due diligence, then there's a lot of scope of growth. So when we talk about investments in other ways of maybe TFSA or others, you're still investing, right? And you want some passive income to be generated. In the same way over here, when you're investing in these segments or these cities, the market has tremendous scope of growth without a cap.
So let's set a bit of a statement here. There's no such thing as a no-risk opportunity.
No risk, no reward.
Okay, well, let me even correct myself. Yeah, exactly, no risk, no reward. Outside of a GIC, which is a government-issued certificate, basically, right? You are guaranteed by the government to see some performance. The question is, does it match with inflation or not? Are you actually ahead or not, or are you preserving your capital? But based on, compared to what we talked a little bit earlier in terms of someone's savvy required or someone's time and energy and effort required to monitor their own portfolio, and I mentioned the term day trader. At the end of the day, there are so many factors that are beyond our particular control when it comes to investing in the stock market. Something that happens in another country, something that happens in a sector, something that happens well beyond our actual control. Now, there is still risk in real estate. People will argue that, similar to Bitcoin, for example, people are saying, well, Bitcoin is the next, saving grace of investment. And that's true, maybe for some, I don't know. But you can't say that real estate is without any risk whatsoever. And someone will argue, well, what happens in the last couple of years when we see real estate prices go down by 35%? What's your response to someone who talks about that?
Definitely. So in investments, in real estate, also there are different segments, right? Multifamily is one segment of investing, right? So when we talk about risk, in this segment, which is multifamily, I find that the risk is one of the lowest among the others because you're diversifying your investments with the number of dwellings being under portfolio. So for example, if you bought, let's put an example of 5-plex, only, right? There are 5 units. You're staying in, let's say, in one of them, right? So owner occupied. Now you have 4 units to be rented out. If, for example, one unit is vacant, right? You're still getting rents from 3 others. Now that is what we're talking about, a little bit of risk tolerance being more here, or you're able to be more secure in your investment because you are able to secure that investment while risking that much money. Because if you have only one tenant in one property and if that is vacant, you're at 100% loss. But if you have 5 and one tenant is not there, but there are 4 are rented out, for example, you are maybe able to offset your mortgage from there. So multifamily is a segment where it's very different than real estate in general, which is buying one unit or we renting it out as a detached home or a townhome to one family, versus this segment is different. And when we compare that with, let's say, day trading, there's no comparison even, right? The one is very high risk, in my opinion, versus real estate could be high risk, but also it bounces back. Like knowing that the trends of immigration to the country, in 2022 alone, 1 million new immigrants came to the country, right? Are we building fast enough? No. That means they all want to rent at this point, right? The people who couldn't afford buying right now, as new generation, a lot of them can't buy right away. So what they're about to do is rent. So your investment in multifamily gets a little more secure because of the markets. Now, again, I'm not going to touch base with only a single detached property because what you mentioned, Arif, earlier, risks are higher in that segment. When you buy a detached property in one city and you're trying to manage that one property. But instead of one, if you have 5 together, that is where the multifamily investment comes into play.
We're about to go to break, but I do want to sort of drive home that point that you made. There are many people who consider investing into a multi-unit as that would be step 2. I should first start with a single unit. I understand that there's some logic behind that, but in fact, what I'm hearing you say, that's actually a very illogical approach to take from a mathematical, unemotional perspective, and that the risk associated, and there are many Canadians where you just have to look at the headlines. I'm not a huge fan of the headlines all the time, but you can look at the headlines and see many Canadians who may have gone into buying a cottage or may have gone into buying a rental unit. As their mortgages came up for renewal, they got a huge shock where they were able to cash flow and manage that responsibility when they signed their 5-year term. And when it came up for renewal, they got a huge shock and they weren't able to manage it. So when we come back from the break, I want to talk to you about what an investor should be thinking about when considering that first initial step into investing in multi-unit real estate investment.
Perfect.
So stick with us. We'll be back with more of Arjun Batra right after this break. Back to Hitting Home, and I'm joined by Arjun Batra, who is a real estate professional with First Construction Real Estate Group serving Ontario and Alberta. Glad you're here. We're talking about real estate as an investment vehicle, and I thought it was quite important or relevant to set the tone in the first segment about our familiarity around real estate. We've either live in our own home or in someone else's home. But we're now talking about not buying a home for our own personal use exclusively, which for many is a very emotional, relationship. We fall in love with our home. It's our castle. It's our sanctuary. It's the place we want to. It's our forever home. There's lots of different emotions that can be attached to that. We're actually talking about real estate as an investment opportunity and finding its place in our portfolio, because we got a lot of products and recommendations being sold to us by a variety of people. I wanted to get into this concept of multi-unit with you, though, and in order to really have a healthy conversation around it, I think it's important to set the tone on what multi-unit really means, and maybe you can give us your perspective on that.
Definitely, RF. So I think it's very simple. I mean, think about it as a duplex right now, to start as a one-on-one for this, right? I mean, I'm living in one unit and I'm renting the other. It's supposed to be called as a multi-family, right? As a one-on-one for the beginner, right? But when you scale it up, you can say that I'm living in one of the units in my 5-unit building. Now, again, that's a multi-family, right? You are, saying it that I'm living with my family, right? They want to rent space from me, right? So it could be anything which is your family living or you're living, plus there are more legal units where you're renting it out for income purpose. So that's multi-family.
Okay, perfect. And when it comes to financing, there are some unwritten or maybe even some written rules with the finance companies, with those lenders and banks around the size and shape of your portfolio. And that's depending on when you go over a certain number of units, you can really change from being viewed as a regular homeowner who's doing this for personal investment. Suddenly you sort of go over this invisible line into this is a commercial operation.
Yeah, so it's generally anything less than 5 units. When you're buying or you're going to the banks, they will call it as a residential financing. Anything when you have 5 units and more, in general, like again, it could be around starting from 7 units too, depending on which lender, but anything with 5 and plus units, it goes in the commercial side. Now, there's a huge difference between the residential side and commercial side, because a lot of people don't understand that. People think, hey, I'm not unable to get it financed for 1 unit. How will I be able to get financed for 5 units right now? And that's a very regular question people ask, because people think that, my income has to be supporting those 5 units. But actually, it's not the case. Basically, what you're generating from that multiplex, let's for example say, if they're 5-plex, right? If 5-plex is rented out, now that is generating an income. Now, when you go to finance that property, the bank will look into it, hey, there is an income being generated, so your income is not as much required because that asset itself is generating the income. And that's what the beauty about commercial lending becomes. People get confused and people think that, hey, it's too hard to get commercial. No, actually it's easier to get the commercial side of things here.
Let's back up just for a second and make some sense of it.
Yeah.
All right, because I'm sitting at home, I'm watching these 2 crazy guys talking about this, and you're trying to convince me it's easier to get financing for 5 units over 1 unit. But let's make some sense of it. We talked about in the first segment the concept of risk. Banks are risk averse. Their job is to avoid risk. Their job is also not to want to take over the property and become a landlord themselves. They just want their money back. They want you making your payments. The idea of a single unit or a live-in-one plus 1 unit, the risk is that if that 1 unit is vacant, I'm stuck. The bank's looking to me. The bank wants to make sure that when they look at the numbers to see if I can support this, if that 1 unit that I'm so heavily dependent on becomes vacant, can I carry that difference? Versus what you're talking about, which is a lower risk associated because it becomes a numbers game. If 4 units are occupied and 1 becomes vacant, which is going to be normal from time to time, will the 4 carry it, and how much demand is there to fill that 5th?
100%, and that's the numbers game. That's why it's economy of scales kick in over here when the lenders are looking at it. They are looking at it from the angle that this is a lower risk, because before they even lend you the money, they will crunch the numbers, right? So they are definitely making sure that before the lending is given, is it supporting? Is it going to be okay that how much cash flow you're making? They have debt service ratios. They have other ratios to back the numbers, and then they lend. And they are very happy to lend because they know the numbers will always work in the favor because of the strong rental market in the country.
So I have a job. I am in any other profession other than real estate whatsoever, and I'm bringing food home, I'm bringing income home to support my family, and now all of a sudden I'm having to become a landlord? Tell me about that. Tell me what the options are for me as an investor taking a look at multi-units.
Definitely. So I think the best way to get started is you become the landlord, experience it, and see is that the thing for you or not, right? If you feel that by having one tenant or two tenants, you can manage it, you enjoy that a little bit, you can continue doing with more number of units. Let's say you become 5 unit, you can manage it because you have inclination towards property management. A lot of the investors feel that they want to have only passive income. They don't want to be part of the operations. They want the money to be parked the way the TFSA or the way the GICs are working, or any other investment where they park and they keep getting the interest as a passive income. You can do the same, but now you have to also have the expense of a management company who will be managing the property for you. So that gets a little expensive, and that only makes sense when you have more than 5 or 7 units, that you have a property management who will manage it for you.
And I do think it's important for somebody to speak to their accountant who is familiar with real estate and familiar with multi-units. And I think that making note of that familiarity with your accountant is important.
100% professionals.
They need to understand. Yeah, I think that there are accountants who have certain areas of expertise or specialty, though, and I think it is important to find one who understands this, this industry. It should be noted that when you are speaking with your lender and you're doing a pro forma statement and you're looking at your net operating income, basically you have your gross revenue come in and then you back out some of your expenses and you see what you're left over. That's your net. I'm sure there are examples of that online, or you can have that discussion with someone. However, you can actually look at those line items as, are you hiring and incurring an expense of a property manager, or are you taking that from expense for yourself and keeping it all for yourself? I don't know, is there a difference between whether you claim that income just on your net, or if you actually are paying a family member to be the property manager? Is there a benefit to looking at things that way?
I feel both of them have its place. If you're doing a small operations run, totally you can count on a family member. But if you're about to get more number of units, then I recommend, if you're not doing it, hire a professional who will take care of your property. Because then you have property taken care of, the tenants are happier, and I feel that is the right approach to expand, because when you are not worried about the property and managing and making sure your family is taken care of, but you're some professionals doing, then you have more space or more ability to grow your business or grow more number of units, basically.
Yeah, I think it's important to understand that if you're going to take on this role as a landlord or the property manager, you are on call 24 hours a day, 7 days a week.
And that's a choice which people can make, right? If that's what they want to do, fair enough. But then as they grow, they should think about not being an operator, but as an investor who is looking for passive income from this.
So again, before we wrap up this segment, I also think it's important to decide, I'm not selling you on a concept of getting into multi-unit residential. There is a question behind that, and that is, what do you want out of life? What do you want out of life that your current occupation, your current profession, your current job is not yet quite able to get you that long-term goal that you're looking for? So I'm personally listening to you speak and saying, I didn't set out to want to be a landlord. I didn't set out to want to be a property manager. So sometimes we get caught into well, let's look and let's start dissecting this and overanalyzing it, et cetera. I think it's important for us to actually step back and say, what is the actual benefit that this vehicle will allow or afford me in my life? My goal may or may not be to be a property manager. My goal may be to have that passive income. And when we come back from the break, I really want to talk to you about the concept of active versus passive income before we go into, once we have that understanding, how freeing that can become in letting go of sort of the micromanaging of our portfolio. So when we come back from the break, we are going to cover a little bit on the difference between passive and active income. Stay with us. Welcome back to Hitting Home, and we're talking about, before the break, getting into the concept of multi-unit and why multi-unit actually is viewed by lenders as lower risk and a better investment strategy and opportunity than a single individual deciding to take on the task and the obligation, the liability, the burden of one extra unit. And I love how you broke that down and made it so very clear. So thank you for that. Let's pick up where we left off, though. And before we went to break, we said, let's have a little bit of understanding of the difference between active and passive income. So take it away.
Definitely. In real estate, active and passive income could be very simply broken down as how much work you want to put in, right? So if you want to be an active investor, or if you want to be an active landlord, then you're putting the work in terms of being on call 24/7 as a property manager. Something breaks down, you have to be reaching to that space maybe, or answer the questions midnight or whenever it may be, right? So that is one of the things. If something needs repaired, again, you have to be accountable and get things done quickly. As a passive investor, you're hiring a team, and that's where you're building a teamwork. You are counting on other people to be working, and as a property manager. So that becomes more like a passive income. Now, yeah, your share might be a little bit lesser of as a profits, go a little bit lower because you're sharing that with a team, like you're paying out as an employee to someone, but then you're not worried about 24/7 being on the call. You can be on a vacation, you can be anywhere, right? And then you're still knowing that the team is doing their job, basically. Right? So that becomes a passive investment.
Now, there are certain stages that you'll go through as an owner and a landlord when it comes to sort of stepping away from the day-to-day duties. And there are some environments, maybe it's a sixplex, where the landlord offers a rent discount to somebody who's their tenant, who proves that they are able to care for the daily maintenance of the property. Maybe it's cutting the grass, keeping things clean. Maybe they have some handy skills. I don't know about the handy skills. I'm a firm believer in hiring a professional, but I don't know who you have as your tenant. So there is an entry level in working with someone within your tenant pool to assist with some of that. You don't have to necessarily hire a full-time crew. You don't have to necessarily hire an employee. You can, of course, subcontract that out. But again, there's going to be a positive and a negative around hiring versus subbing out. Subs probably want to make some more money.
Yeah, that's right. So you're absolutely right. This is the different stages of investments in real estate and in multifamily real estate. You start maybe with a duplex, as I said. You get a feel of it, and then as you grow with more number of units, for let's say 5 units, if you have, you might have a tenant. Who can do some of the basics for you. You can offset some of their rent because of that. Works. Now, when we talk about property management, or we talk about full-time hired staff, generally, rule of thumb is 16 units when you have under your management, you can have a full-time employee, which would be just in your corporation who's doing the work for you alone. That is one of the ways of looking at it. You can have a full-time employee, or you can just outsource it to a local company. They might charge anywhere between 5% to 10% in that bracket of property management fees. But again, they have their expertise, which they bring to the table, and you don't have to rely on your own recruit. You can have that team do the job, which has different expertise in it too. Like, for example, if you want landscaping to be done, you can hire them through the property management, or they take care of things and they just bill you for that, or snow removal. So they have one shop. They do it all for you, basically.
And it doesn't have to be a single property that has 16 units. It could be 3 properties with 5 units or something along those lines. Obviously, that doesn't add up to 16, but it can be spread across a number of different properties. So now we're talking about active versus passive. We're talking about setting and forgetting is, I think, something that you mentioned earlier. You talked about economies of scale. You've thrown out some different terms that you're certainly familiar with in that space. I'm about to take my first step. This is a big deal, and this is a big decision that needs to be made. And I might either be an emotional individual, or I might have a partner who thinks I'm crazy or is questioning the rationale or something along those lines. You got to be healthy. you have to walk with confidence. You have to make a decision. Now, each one of us makes decisions every single day. We make decisions on which way we're going to go to work. We make decisions on what product or company we're going to support in other areas of our life. How is this any different? And what do I need to know? How do I actually face and address the potential that I might be a little bit emotional or nervous or scared about these decisions that I'm looking at making?
It's completely normal to be emotional in the beginning, but sooner you can get this thrown out of the window, the better it gets, right? This is an investment. You have to remove emotions and then invest. As soon as you are invested with emotions, it will be so much harder for you to grow in this segment, like any other investment. You know, you got to move. You got to move with the market quickly. While you're owning your own property, it's understandable to be emotional while you're renting your basement out. I get it, that part. But as soon as you go into the more of number of units, you have to move quickly without emotions. That means if you have to hold that investment, you hold it. If you have to let go of it, you let go of it based on the market's trends, right? If you have to take care of things at a certain time, you get it done, because you can't mix your emotions when you're investing in real estate. Otherwise, often people lose money. So whoever is emotional, at the end will always pay the higher price. May it be buyer or the seller in this segment as well.
Yeah, so these are words to live by in this particular case then, in terms of you deciding to hire a property manager versus be the property manager. Because the more time you're spending on site and maybe getting to know your tenants, you are likely setting yourself up for, even without your own conscious knowledge, you're setting yourself up for an emotional interaction with an individual. So backing out and deferring or to the expertise of a property manager may be one way to set a bit of a line between you and your tenants.
100%. So let me share this with you, that most of my clients who are investors, they have not even gone to the property they buy. Like, because this is a numbers game. When the pro formas are run, when the Excel sheets are created, it should make sense on the sheets, right? Is it cash flow positive or not, based on the market research? So when everything is in that Excel sheet and the numbers are working, right, they don't even go to those cities where they're buying. They're buying buildings which are like 15 unit, 20 unit could be. Right? They've never been to the city even, because they're relying on teamwork. They're relying on the right professionals in those cities. They have the right people to reach out to. And recently, I was talking to one of my investors, and it was a very interesting story. Her wife said to me, "I'm so happy that the investment is not in my city. It's outside. It's so far that my husband cannot go there every time. Because if that happens, it takes away time from my family time, right?" So what it is doing is training your mind to let go at times. It's training your mind to trust in the team, right? And that is the right approach. When you get that skill set, you think that, oh wow, I mean, I can invest in different parts of the country and in different places. So it's a mindset. It changes the mindset to think that you have to build a team. And that's where I feel it doesn't start from there, but it should eventually be there.
Mm-hmm. I love how you frame that, and you make that very easy to digest. And I think there is a line or a difference between renting out an apartment in my basement and me being very selective about who that tenant is. Who do I want around my children? Do they have certain habits that may or may not align with my habits, or belief systems that may or may not align with mine? And it can get pretty confrontational pretty quickly, depending on how I am as an individual and how they are as an individual. So setting that aside, these are two very different worlds. Mm-hmm. Very different worlds. And I think for anybody who is at home thinking right now, well, I've tried it by renting out a room, I don't think it'll work for me, I think that point was missed there. And I think it's important to realize that this is a very different model.
100%. Very different model and very different way of operating.
So you touched on the fact that you have a client, you brought up that case, that you have a client who's thankful that none of their investments are actually in the city they live in. Tell me about me as an investor taking a look at where I want to live, for myself, and my home might one day become an investment if I no longer have a mortgage, and if I decide to sell it and I decide to realize the gains through appreciation. Now that created an asset for me because there's a sold sign and someone handed me some cash. But in the meantime, I'm living here. And I'm living here because of the quality of life I want for myself, for my family, my friends, etc. What should I be looking at in terms of a city or a location in which to invest from the numbers game perspective of providing units for people to live in as an investment tool?
Definitely. I think that's very important, the due diligence before for an investor. I mean, you spend more time on the computer and the research than anywhere else, because once you have shortlisted the city you want to invest in, then you dig in further. So what drives that number or that decision is employment, population. So I mean, it's a very good saying that, invest wherever the people are going, right, in real estate. So if people are moving to, for example's sake, just giving an example right now in Edmonton, Alberta, right? I'm going to very closely follow Edmonton to see that, hey, the price of ownership or the purchase price is lower, right, compared to other, but the rents are higher. So as an investor, I would look at it, where can I buy a property where I don't have to dispense that much of money to own maybe a triplex or fiveplex, but the rents are very strong. So for example, oil and gas segment, right, over there in Alberta is very strong still till today, right? I mean, and then people are able to have the highest average rental income. So just to give you an example of what average rental income is, because you asked about how to come to a decision making, Stats Canada generally creates all these numbers for people to go over. So what average rental income is, that let's say that City of Barrie has 100 people who are renting the property. 100 people are renting the properties in City of Barrie. Then Stats Canada would just somehow they find out that what is each family earning of those 100, and then they average it. So for example, if there are 100 people and their average income in the City of Barrie is $60,000, right? Now that 60,000 is a base for me now to see that in the City of Barrie, the average rental income is 60,000. That means whoever is renting is earning around 60,000. While in Edmonton, it is, that's a 65,000, or maybe in Toronto, it might be lower than Barrie even, because the population are more, right? So all these metrics I have to keep in mind while we are thinking about where to invest, and that's the most important part, and that's where professional comes in, like our team comes into play. We completely research the market, we come down with the numbers, we come down with those areas where the population growth is happening today and where the scope of growth is more in the coming time.
Mm-hmm. And I think that that's critical. Obviously, Toronto is recently gone through some interesting time with regard to vacancy, certainly in the condo sector, also in the commercial space. They've gone in, they're facing some really hard times regarding the value of their portfolio. Again, related possibly to the pandemic, and people have sought to live elsewhere. They've realized that they can work remotely. The technology is on their side. They can get a better quality of life living in another city. However, the ability for an individual to qualify for home ownership is still very high compared to the last decade, for example. So that individual moving to Edmonton and accessing home ownership might still be beyond their reach. They've got income, they've got stability of income, but they don't have the ability to qualify to carry the debt, and that's where this opportunity comes in for your clients.
100%. I mean, again, these things are most on opportunity based, wherever the pricing is lower and people are able to get higher rents. Toronto, on the other side, I mean, it's a very good market in general, but right now with the condominiums and how it is, you're buying a condominium for $800,000 while the rents will not even support that mortgage. So, I mean, how can you justify it as a good investment? Again, I mean, in the past, when the property values were lower and the rents were higher, it was justifiable, right? But now, in the last 5-7 years, the market has gone up, the property values have gone up. No one wants to sell at a discount of 2018, 2019 anymore. They want to expect a price which is a lot higher, but the mortgages are not supporting it. So that's why it's not the best condominium investment in today's market. I mean, could be debatable, but I mean, I feel that it is a tough situation for many people who have invested in condominiums in a city where They've paid a premium to purchase a property.
When we come back from this break, I want to talk to you about why being the smartest person you know could be a very dangerous thing. So stick with us on the other side of this break, and we'll talk about building that team, the value of a team. We'll also talk to you about some programs that make acquiring or getting into this investment class more accessible than you thought. So stay with us on the other side of this break. Welcome back to Hitting Home, and we're talking about real estate as an investment product. And you know, so many people in coffee talk, table talk, conversation, around the water cooler, if there is such a thing in the place that you work, talking about how hard it is to just, if I could just catch a break, if I just could get ahead. And I think this conversation is so valuable that we're having today, Arjun, because in order to make a difference, in order to have an outcome that is different from what you've been experiencing so far, that is different from maybe what your friends, family, neighbors have been experiencing, maybe it's different from what you just hear about in terms of the constant noise that is maybe less than as optimistic as you would like. This is something we need to have a discussion around this. How can I do something different? How can I do something different from the norm in order to exact a different result? And that's why I'm really glad that we're having this conversation today. It can sound foreign, it can sound out of reach, but it's not as out of reach as we might have been led to believe. So thank you for being here with me, and I'm glad we're having this conversation. We went to break with kind of a smart remark from me about if you're the smartest person you know, you might be in trouble. But the importance of building a team and the importance of putting good people around you. Talk to me about what kind of a team you want to be putting around you if you're going to consider this as an opportunity for yourself.
Definitely, Arif. So first thing is get the right real estate agent who specializes in multifamily, who understands the market trends and where to invest and which markets to study for you as an investor. Second thing is you should have your finance team, right, who will be working with you in terms of getting the financing done. There are different ways and creative ways of getting financing through. The third team which you're looking for is property management. Now, property management can have a more number of people under them, or you can hire them individually, or you can hire one company. So it all depends on where and how you want to hire your property management. So these are the three key people whom you should be having the best. Now, obviously, you'll be at some point needing a lawyer, right? If you have a lawyer in your own province, great. If the investment is in a different province, then my recommendation is look for a lawyer in that province rather than your Ontario lawyer. So these are the key people, actually.
Okay, and again, I think the takeaway from the last three segments and going into this one here is you may not be utilizing this because you dreamt of being a property manager, you dreamt of being a landlord. It's about the quality of life that you want to extract for yourself. And this is a way to net some passive income that is different than many of the other structures or products that are out there. You've got to decide for yourself if those, how's it going so far? I'm 53 years old. How's my portfolio going so far? If it hasn't yet sort of manifested as one that I have a lot of confidence that I'm going to be able to have a healthy retirement, maybe it's time to look at something a little bit different. Now that I've got a team in place and I'm taking someone to task to prove to me some case studies that are real and live samples that you can show me, now what? Now how do I get involved in this? And talk to me about some of the actual government incentives and programs that are out there that are, you're telling me, they are supporting this as a business model, they're supporting this as an investment model. Why?
So first thing to all the viewers, I would definitely say in real estate, knowledge is wealth. So if you have the knowledge, if you have the knack of reading and listening to the professionals, it will give you so much head start compared to your neighbors or compared to people, family members, who all they know is to buy a detached property or a townhouse or a condominium. They are unable to move past that barrier of buying a single unit. But as soon as you start talking to the right people, it will elevate your scope of growth to a point where how can you now tap in and how can you get that done which you have never dreamt of. So when we talk about excuse me, when we talk about investments in this, obviously finance team has to be in place. Now when we're talking about finance, we're also talking about government programs. Now in the recent times, government sees that, hey, we cannot solve the problem of affordable housing alone, right? We need private sector to kick in and put some money in. Now, how does that partnership work? And that's where the best part for investors are today, right now, because the investors can look into what the programs are there and how can they leverage those programs to buy multifamily. So one of the programs which the government has under the CMHC, it's called MLI Select, where you can buy properties under the affordability criteria with only 5% down and 50 years of amortization. Now, what it tells you is that, for example, if you're looking for buying a $1 million property, which is, let's say, 5 units in it, in a remote area, and this is only for example's sake, okay? So don't quote me on it, but let's say you're buying something for $1 million, you need only $50,000 down payment, right, in that segment. Now, compared to if I had to go out and buy a second investment opportunity, we all know it's 20% down, right? There's a huge shift. Now, if people don't know, they always think that, hey, you know what, we need 20% down to buy an investment opportunity, while if you are going into the program where you're creating affordable housing, now you have different ways of getting it done. It's more creative. That's why I keep saying it's a lot easier than people think. People have that mindset that, oh, we're talking 5 units, I can't even buy one more unit, how can I afford 5? But actually it's very different. It's a very different world of investment.
Let's repeat that one more time a little bit slower, because I really want that to be digested by those who are listening. You are absolutely correct. If I'm buying my home for the first time and I'm buying my home under $1 million and I'm buying my home for my own personal use, yes, I can go in and go in with an insured program and I can put 5% down. But the most that I'm going to get is probably a 30%, a 30-year amortization, and yes, I can do 5% down, and I'm using that for my own personal use. Okay? But the moment I want to buy a single additional unit for the sake of investment, I no longer have the right to access 5% down. I have to come up with 20, and also or more. Depending on what my income says I can carry, yes, absolutely, or more. The risk is seen as higher by the lender who's doing the underwriting, because again, if that unit becomes vacant, I have to show that I can carry 100% of the cost. So there is a debt servicing ratio. They typically will want to see 1.2 times the amount of income compared to the debt, if not 1.25. So I'm not able to use 5%. I'm not able to, I have to show that I can carry it myself. And in addition to that, there are a number of other factors that are put upon me as carrying that liability. So what I wanted to get into with you is the fact that it's not necessarily just cheaper, but 30-year amortization versus a 50-year amortization is a massive difference in terms of what my cash flow and my carrying costs are. So talk to me about, first of all, for those of us who are at home thinking about what does an amortization mean, it means how long does it take for me to pay my mortgage down to zero? Okay, 50 years because of a average life cycle of the unit?
So 50 years is again, it's up to 50 years. It all depends on a lot of factors. So you need to talk to your finance team about all the nitty-gritty. But yeah, the government says that, okay, well, in order for us to create affordable housing, if the investor has to pay a bigger monthly installment, then it's become hard for them to, even break even at 5%. The only time they will be able to, as an investor, I'll be able to make something out of it is if the spread is longer. So the spread in this scenario is, let's say, 50 years. So then you're putting lesser monthly installment for your property, while the rents are giving you some cash flow.
Now, this is where you also want to talk to an accountant. The fact of the matter is that when it's your own home, yes, a goal should be, how do I get my mortgage down to zero, so that when I'm maybe earning less income, maybe I'm on some fixed income, maybe I'm on some pensioned income, my ability to stay in my home is more secure. When it's an investment property, it's actually a good idea to have a mortgage. It's a good idea to, what? Let the tenant pay the interest. Talk to me about that for a moment.
100%. I mean, when the tenant is paying for the interest, you're able to offset a lot of the cost as tax write-offs, right, from your company. So there are a lot of things which you can do in a creative way in terms of offsetting some of the costs, which in your personal investment you wouldn't be able to.
Mm-hmm. So yes, and I think that is important. And again, neither of us is a lawyer, neither of us is an accountant. It is important for you to tap into that expert. However, having a 50-year amortization gives you that greater flexibility and leverage and ability to carry the burden, but also there is a strategy behind having a mortgage and allowing that mortgage expense to offset your income and reduce your tax liability. So these are things definitely that you want to tap into. Now, someone's going to want to get started. We've got just a moment to wrap up. What is the first thing that I should do if I've loved what you've had to say, I'm considering this for myself? The number one thing that you want me to do when we turn off this show and we're thinking about it is what?
Well, first, talk to a good real estate agent who understands the market, who shares with you opportunity. Number two is look for the right mortgage team around you and go and share your assets with them. Tell them that what you own and share them what will be your qualifying number be, and then go back to the real estate team again and say, hey, you know what, this is my number. That's a maximum I'll be able to get qualified based on X number of reasons, right? I mean, for example, in this scenario, when you're going to your team, you have to share with them your assets. And then based on that, your team will tell you, okay, you can buy up to, let's say, $2 million of multifamily. And then your real estate agent should be able to get you good properties showed for that $2 million.
So $1 million in the scenario, $1 million, 5 units. We've talked about the fact that we've examined the rents in that local area. They're more than covering that obligation. I don't have $50,000 myself. I've got $30,000 myself. My spouse doesn't want to have anything to do with my crazy idea up front, and so I'm going to go down this path myself.
Yep.
What is the common, how common is it for two strangers, friends, business partners, people that meet in a networking group to get together and come up with that $50,000?
Very easy, because now these are all under corporations. When you buy in, you become directors of the corporations. Again, reach out to the lawyer to get how the corporations form. You have contracts, which is generally under called JV, joint ventures. You have contracts with the exit strategies written down that, when someone wants to exit out. So depending on how you want to structure a deal with your partner, put down all on a contract, right? And then execute it. So everyone is, you can have 3, 4, 5 partners for bigger ventures, and then they all pitch in some money, and based on that is a shareholder, how much is the shareholding of the company.
Yeah, so this is not a marriage with a spouse that is, and quite reasonably and realistically, an emotional transaction. Whether you're doing this as a single, whether you're doing this with your spouse, or whether you're doing this with a complete stranger, right back to the basics, this is not emotional, it's a numbers-driven game. It is driven with paper and contracts, and it is something that's based on logic and numbers.
Definitely, Arif.
Arjun Batra, I want to thank you very much for spending this hour with me. Really appreciate it and learned a lot. And for you at home, I hope you got something out of it as well. And you've got Arjun's information in the show credits here as well. Arjun First Construction Real Estate Group. Thanks for being here.
Thank you, Arif.